There's something almost invisible moving through the economy right now, a rhythm so consistent that once you see it, you can't unsee it. Every 40 months, like clockwork stretching back over a century, businesses around the world go through the same pattern. They build up inventory, then they slash it. Prices rise, then they fall. Hiring accelerates, then it stops cold. And most people never notice because they're too busy living through it to recognize the pattern. This is the kitchen inventory cycle, and it's been operating in the background of the global economy since before your grandparents were born. Named after a British statistician who discovered it in 1923, this 40-month rhythm has shaped more business decisions, more job losses, more price swings, and more economic pain than almost anyone realizes. Because while economists have known about this cycle for over 100 years, most business owners, supply chain managers, and even traders have never heard of it. But that's about to change, because once you understand how this cycle works, you'll start seeing it everywhere, in the shipping containers stacked at the ports, in the empty shelves at the grocery store, in the sudden layoffs at the factory down the street, in the price of steel, lumber, semiconductors, and everything else that moves through the global supply chain. And here's what makes this particularly interesting right now. We're sitting at a moment in history where this 100-year-old pattern is colliding with modern supply chain practices that were specifically designed to eliminate it. Just-in-time inventory management was supposed to make the kitchen cycle obsolete. Companies weren't supposed to build up massive inventories anymore. They were supposed to order exactly what they needed, exactly when they needed it, creating a smooth flow of goods with no excess, no waste, no cycles. But then 2020 happened, and what the world discovered is that you can't engineer your way out of human psychology and mathematical inevitability. The kitchen cycle came roaring back with a vengeance, catching an entire generation of supply chain managers completely off guard. So let's go back to the beginning. Let's understand what Joseph Kitchen discovered in 1923, why it matters, how it works, and why every business owner and investor needs to understand this pattern right now, because we're heading into another turn of the cycle, whether anyone is ready for it or not. Joseph Kitchen was not an academic. He was a businessman and statistician who spent his career analyzing economic data, looking for patterns that others had missed. In the early 1920s, he gathered decades of information on bank clearings, commodity prices, and interest rates from both the United States and the United Kingdom, spanning from 1890 to 1922. He was looking for regularities, for cycles, for something that would help explain why economies seem to expand and contract in predictable ways. What he found was remarkable. Buried in all that data was a clear pattern, a cycle that repeated every 40 months on average. It wasn't the only cycle. Kitchen also identified a longer cycle of 7 to 10 years, what would later be called the juggler cycle. But this shorter rhythm, this 40-month pattern, was something different. It was faster, more frequent, and it seemed to be driven by something very specific: inventory. Kitchen's insight was elegant. He realized that businesses don't respond to economic conditions instantly. There are time lags built into every decision. When demand starts to rise, businesses don't immediately notice. They sell down their existing inventory first. When they finally recognize that demand is increasing, they don't ramp up production immediately. They have to make decisions, place orders, wait for deliveries. By the time production increases, more time has passed. And here's where it gets interesting. When production finally ramps up, it doesn't stop exactly when demand peaks. Businesses overshoot. They produce too much. They build up inventory beyond what they actually need because they're still operating on outdated information about demand. The market floods with goods. Prices start to fall. Companies see inventory piling up in warehouses and they realize they need to cut production. But again, this doesn't happen instantly. More time lags, more delays between recognition and action. Eventually, production drops below consumption. Inventories get drawn down. The cycle reaches bottom. And then it starts again. 40 months on average from peak to peak or trough to trough. Kitchen had discovered what would become known as the inventory cycle, and his 1923 paper would go on to influence generations of economists, including Joseph Schumpeter, who would later incorporate the kitchen cycle into his comprehensive theory of business cycles. But here's what's crucial to understand. Kitchen didn't invent this cycle. He discovered it. It was already operating. It had been operating through the Industrial Revolution, through world wars, through technological revolutions and economic transformations. The 40-month inventory cycle was a fundamental feature of how capitalist economies function, as reliable as gravity, as predictable as the tides. To understand why this cycle is so persistent, we need to understand the mechanics at a deeper level. Think about how businesses actually make decisions about inventory and production. Every business faces the same fundamental challenge. They need to have enough inventory to meet customer demand, but not so much that they're wasting money on storage, on obsolescence, on tied-up capital. In an ideal world, businesses would produce exactly what customers want, exactly when they want it. But we don't live in an ideal world. Businesses operate with imperfect information. They have to forecast. Demand and forecasts are always wrong to some degree. They have to manage supply chains that involve multiple stages of production, multiple suppliers, shipping times, quality control, all of which introduce delays and uncertainties. So what happens? During economic expansions, demand starts to rise. Businesses initially meet this rising demand by selling down their existing inventories. Warehouse shelves start looking a little empty. Stock-to-sales ratios decline. This is phase 1 of the cycle. At this point, businesses are cautious. Maybe this is just a temporary blip in demand. Maybe it won't last. So they don't immediately ramp up production. But as weeks turn into months, and demand keeps rising, businesses start to worry. They're running low on inventory. They might miss sales if they don't have products available. Customer service suffers when you can't fulfill orders. So they make the decision to increase production. Orders go out to suppliers. Manufacturing lines speed up. Hiring increases. This is phase 2. Here's where the time lags become critical. It takes time for those production increases to materialize. Raw materials have to be ordered and delivered. Production schedules have to be adjusted. New workers need to be hired and trained. Depending on the industry, this process might take weeks or months. During this lag period, demand might still be rising, which reinforces the business's decision to produce more. Eventually, increased production starts hitting the market. Inventory levels start to rebuild. But here's the problem. By the time production has fully ramped up, demand might already be starting to slow. Maybe interest rates have risen. Maybe consumers are cutting back on spending. Maybe there are early signs of economic weakness. But businesses don't see this immediately. They're still producing at the higher rate because that's what they planned months ago. This is phase 3, and it's where the trouble starts. Inventory accumulates faster than it's being sold. Warehouses fill up. Storage costs rise. Products start to age, and in some industries they become obsolete. Prices begin to soften as businesses try to move excess inventory. Profit margins compress. The businesses finally recognize they have too much inventory, and they need to cut production. But again, this doesn't happen instantly. Orders to suppliers can't be cancelled overnight without penalties. Production lines can't be shut down without costs. Workers can't be laid off without severance and unemployment insurance impacts. So there's another lag between recognizing the problem and acting on it. During this lag, inventory continues to build. Eventually, production cuts take effect. This is phase 4. Manufacturing activity slows. Orders to suppliers decline. Workers get laid off or hours get reduced. But the inventory is still sitting there in warehouses. It needs to be sold through. So businesses keep selling, drawing down that excess inventory, but they're producing less than they're selling. This continues until inventory finally gets back to normal levels, or even drops too low, setting up the conditions for the next cycle to begin. From start to finish, this process takes about 40 months on average. The exact timing varies by industry, by economic conditions, by the severity of the cycle. Sometimes it's 35 months, sometimes it's 45. But the pattern is remarkably consistent over time and across different countries. And here's what makes it so powerful. This isn't just happening at one company, it's happening across entire industries simultaneously. When the cycle turns, it turns for everyone at roughly the same time. Steel producers, automobile manufacturers, electronics companies, they all hit their inventory peaks and troughs in sync. This synchronization amplifies the effects. When everyone is cutting production at the same time, the economic impact is much larger than if these decisions were spread out randomly. Now you might be thinking, surely in the modern era, with computers and sophisticated forecasting and real-time data, businesses should be able to avoid these cycles. They should be able to produce just what they need, when they need it, smoothing out these fluctuations. and you'd be right to think that. In fact, that's exactly what businesses tried to do starting in the 1970s and accelerating through the 1980s and 90s. They developed something called just-in-time inventory management. Just-in-time, or JIT, was pioneered by Toyota in Japan after World War II. The concept was revolutionary. Instead of keeping large inventories of parts and materials, Toyota would arrange for suppliers to deliver components exactly when they were needed on the production line. Not a day early, not a day late, exactly when needed. This required unprecedented coordination with suppliers, tight quality control because there was no buffer inventory to cover defective parts, and sophisticated logistics planning. The benefits were enormous. Storage costs plummeted because you weren't warehousing months of inventory. Capital tied up in inventory dropped dramatically, improving cash flow. Obsolescence risk decreased because you weren't holding products that might become outdated. Efficiency soared because production could respond quickly to changing customer preferences without having to work through old inventory first. By the 1990s and 2000s, just-in-time had spread from automotive to virtually every industry. Retailers like Walmart used sophisticated computer systems to track sales and automatically reorder products to arrive just as existing stock was selling out. Electronics manufacturers operated with weeks of inventory instead of months. The entire philosophy of supply chain management shifted from just-in-case to just-in-time, and for a while it looked like the kitchen cycle might actually be dying. Research from the early 2000s suggested that inventory cycles were becoming less pronounced in developed economies. Businesses were better at matching production to demand. The amplitude of inventory swings was smaller. Some economists suggested that better information technology and improved supply chain practices had fundamentally changed the dynamics. But there was a problem that nobody fully appreciated. Just-in-time only works when the supply chain is stable and predictable. It requires reliable suppliers who deliver on schedule. It requires functioning transportation networks. It requires stable demand patterns. And most importantly, it requires that nothing goes catastrophically wrong because there's no buffer, no safety stock to fall back on when disruptions happen. For decades that worked. Supply chains became more complex, more global, more tightly integrated. A smartphone might have components from 50 different suppliers across 20 countries, all arriving at assembly plants in China on carefully coordinated schedules. It was an engineering marvel, a triumph of logistics and coordination. But it was also fragile in ways that most people didn't recognize. And then came 2020. The COVID pandemic hit, and the entire just-in-time system revealed its vulnerability. When China locked down in early 2020, factories shut down. When they reopened, the rest of the world was locking down. Shipping routes were disrupted. Port workers got sick. Truck drivers couldn't cross borders. The finely tuned global supply chain lurched to a halt in some sectors and went into overdrive in others. Consumer demand patterns shifted violently. People stopped buying clothes and started buying home office equipment. They stopped going to restaurants and bought groceries. They stopped traveling and bought bicycles and home gym equipment. These demand shifts happened so fast that forecasting models, which relied on historical patterns, became useless. And here's where the kitchen cycle came roaring back. Businesses initially drew down inventory as demand surged for certain products. Then they tried to restock, placing massive orders with suppliers. But suppliers couldn't keep up because their production was constrained by the pandemic. So businesses overordered, trying to secure whatever they could get. This overordering itself became a form of inventory building, except it was invisible because the inventory was stuck in the supply chain, in shipping containers waiting at ports, in warehouses that couldn't get labor to process shipments. By late 2020 and into 2021, we saw the classic kitchen pattern playing out in slow motion and at massive scale. Semiconductors provide a perfect example. When the pandemic started, automakers cancelled their chip orders, assuming car sales would collapse. But then demand for cars held up better than expected, and demand for consumer electronics exploded as people worked and learned from home. Chip manufacturers shifted production to consumer electronics. When automakers tried to restart production, they couldn't get chips. The suppliers were booked up. Automakers panic-ordered, trying to secure future supply. Electronics makers did the same. Everyone was trying to build inventory buffers, having learned that just-in-time left them vulnerable. The result was a semiconductor shortage that lasted into 2022, even though actual chip production was running at record levels. The shortage wasn't about total production capacity, it was about inventory allocation and the bullwhip effect of over-ordering propagating through the supply chain. By mid to late 2022, the cycle flipped. All those orders placed in late 2020 and 2021 started arriving. Businesses found themselves with too much inventory. Consumer spending shifted from goods back to services as the economy reopened. Inflation soared, cutting into purchasing power. Interest rates rose, demand softened, and suddenly companies were sitting on excess inventory that they'd paid inflated prices to acquire. The semiconductor industry provides a stark example. In late 2022, chip companies started reporting inventory gluts. Companies that had been desperate for supply 18 months earlier were now cancelling orders. Foundries saw utilization rates decline. The industry, which had been in severe shortage mode, swung to oversupply in a matter of quarters. Some analysts compared it to the 1995 inventory cycle, one of the most severe in semiconductor history. This wasn't just semiconductors. Retailers from Target to Walmart reported bloated inventories in mid-2022. They'd ordered aggressively to avoid stockouts, but consumer spending patterns had shifted. They ended up with excess seasonal goods, excess electronics, excess home goods. They had to discount heavily to clear inventory, eating into profit margins. The classic kitchen cycle in real time. By 2023, many industries were in the liquidation phase. Production was being cut to work through excess inventory. Layoffs were starting. Prices were falling from inflated peaks. And this was setting up the next turn of the cycle, whenever businesses finally worked through the excess and started rebuilding inventory again. What this demonstrated is that the kitchen cycle wasn't some archaic pattern from the 1920s. It's a fundamental feature of how production and inventory systems work when you combine human decision-making with time lags and imperfect information. Just-in-time didn't eliminate it. It just compressed it during normal times and amplified it when major disruptions occurred. Now let's look at how this cycle manifests across different industries, because the 40-month average masks significant variation in how the cycle plays out in practice. Manufacturing industries tend to show the classic pattern most clearly. Steel production, for example, responds to changes in construction and automotive demand. When those sectors are strong, steel producers ramp up output. But steel production can't be turned on and off like a light switch. Blast furnaces are expensive to restart, so once production ramps up, it tends to stay elevated even as demand begins to soften. Inventory builds in the distribution channel, prices weaken. Eventually production cuts happen, often more severely than necessary because everyone cuts at the same time. The automotive industry provides another clear example. Car manufacturers work with extensive supply chains and plan production months in advance. When they see strong demand, they increase production schedules, which triggers orders throughout the supplier network. Tier 1 suppliers order from Tier 2 suppliers, who order from raw material suppliers. Each layer adds time lags and potential for amplification of the signal. When demand weakens, the process reverses. Automakers cut production, which ripples through the supply chain. But the impact is asymmetric. It's much easier to cut orders than to ramp them back up because suppliers might have reduced capacity, laid off workers, or shifted to other customers in the meantime. This creates volatility in the supplier network that can take months or years to stabilize. Commodities show inventory cycles very clearly in their price patterns. Copper, often called Dr. Copper because it's diagnostic of economic health, shows regular cycles of inventory building and liquidation. When global manufacturing is strong, copper gets drawn down from warehouses, prices rise, and mining companies increase production. But mining production takes years to ramp up because you have to explore for deposits, get permits, build mines. By the time new supply comes online, demand might have already peaked. Inventory builds, prices fall, mines close, setting up the next cycle. Agricultural commodities have their own version of this, complicated by growing seasons. Farmers make planting decisions based on current prices, but those crops won't be harvested for months. If high prices encourage planting of a particular crop, that increased production all hits the market at roughly the same time at harvest. Prices crash. The next year, farmers plant less of that crop, leading to shortages and price spikes. The agricultural cycle often runs on an annual basis, but it interacts with the longer kitchen pattern in interesting ways. Retail inventory cycles have become increasingly visible to consumers. Before 2020, most people never thought about retail inventory management, but the empty shelves of 2020, followed by the excess inventory discounting of 2022, made the cycle obvious. Retailers use sophisticated systems to manage inventory, but they're still subject to the same dynamics. They forecast demand, order products, and by the time those products arrive, demand might have shifted. The fashion industry deals with this constantly. Retailers order seasonal collections months before they hit stores. If they underorder and a style is popular, they miss sales. If they overorder, they're stuck with unsold inventory that gets marked down heavily. Fast fashion companies like Zara partially solved this by shortening production cycles, but even they can't eliminate the inventory cycle completely. Technology products face an accelerated version of the cycle. Product life cycles are short. A new smartphone model is current for maybe a year before the next version launches. Components like semiconductors, displays, and memory have their own production cycles. When a popular product launches, component suppliers ramp up. But if the next generation product changes specifications, all that capacity becomes obsolete. The tech industry has experienced brutal inventory cycles, particularly in memory chips, where boom and bust patterns can swing from severe shortage to crushing oversupply in 2 years. Now, some industries have tried to insulate themselves from the kitchen cycle through various mechanisms. The pharmaceutical industry, for example, deals with products that have very long development times but relatively stable demand. Once a drug is approved and reaches the market, demand is fairly predictable because it's driven by medical need rather than economic cycles. But even pharmaceuticals aren't immune. Generic drug manufacturers face inventory cycles as they compete on price and try to capture market share. Service industries generally show weaker inventory cycles because they can't really inventory services. You can't stockpile hotel rooms or haircuts. But service businesses still show cyclical patterns in their hiring and investment. When business is strong, hotels renovate rooms and restaurants expand. When business weakens, they cut back. The pattern is similar even if it's not strictly about inventory. The construction industry shows a powerful cycle, though it's typically longer than 40 months. Building projects take years from planning to completion. When demand for commercial real estate is strong, developers start new projects. But by the time those buildings are completed, the market might have changed. Excess office space floods the market. Construction drops. Years later, when that excess has been absorbed and population has grown, shortages emerge and the cycle begins again. This tends to align more with the longer juggler cycle, but shorter inventory cycles in construction materials and equipment still follow the kitchen pattern. Energy markets show inventory cycles very clearly, particularly in oil. Oil producers make long-term investment decisions about exploration and production, but they also manage short-term production through things like drilling in shale formations. When oil prices are high, producers drill more wells, production increases, inventory builds in storage tanks and strategic reserves, prices fall, drilling drops. The cycle repeats. Natural gas shows even more volatile inventory cycles because storage capacity is more limited and demand is seasonal. What's fascinating is how these industry-specific cycles interact and reinforce each other. When the automotive industry cuts production, that affects steel, rubber, glass, electronics, and dozens of other supply chains. Those cutbacks ripple through the economy, affecting employment, consumer spending, and demand for other products. The cycles synchronize not because businesses are coordinating, but because they're all responding to the same economic conditions with similar time lags. And this brings us to a critical point about how the kitchen cycle interacts with longer economic cycles. Joseph Schumpeter, one of the most influential economists of the 20th century, developed a sophisticated theory of nested business cycles. He proposed that the economy experiences multiple cycles operating simultaneously at different frequencies. The kitchen cycle of roughly 40 months was the shortest. The juggler cycle of 7 to 11 years, driven by fixed investment in equipment and factories, was longer. The Kuznets cycle of 15 to 25 years, tied to infrastructure investment and building, was longer still. And the Kondratiev wave of 45 to 60 years, linked to major technological revolutions, was the longest. Schumpeter argued that these cycles don't just coexist, they reinforce or dampen each other depending on their phase alignment. When the peak of a kitchen cycle coincides with the peak of a juggler cycle, you get a particularly severe downturn. When the trough of a kitchen cycle aligns with the expansion phase of a longer cycle, the recovery is stronger and faster. This helps explain why some inventory cycles are mild and barely noticeable, while others are severe and drive the economy into recession. It's not that the inventory dynamics are fundamentally different. It's that the broader economic context either amplifies or cushions the inventory adjustment. The Great Financial Crisis of 2008 provides an example. The United States and much of the developed world were experiencing a housing bubble, driven by excessive credit and speculation. This was a manifestation of the longer Juggler and Kuznets cycles related to fixed investment and infrastructure. When the bubble burst, it triggered a severe recession. But within that broader recession, you could still see inventory cycles at work. Businesses slashed production dramatically in late 2008 and early 2009. Inventories fell sharply. As demand stabilized in late 2009, businesses started restocking, which contributed to the recovery. But that inventory rebuilding only lasted for several quarters. Once inventories normalized, growth slowed again because the underlying problems in the financial system and real estate markets weren't resolved. The pattern repeated. In subsequent years, there were many inventory cycles within the broader slow recovery from the financial crisis. Each time inventories got too high, production would slow, contributing to soft patches in economic growth. Each time inventories got too low, restocking would boost production temporarily. These shorter cycles were operating within the context of the longer deleveraging cycle that followed the financial crisis. Similarly, looking back at the 1930s, the Great Depression was fundamentally a crisis of the longer cycles, a collapse of the banking system, a deflation spiral, a breakdown of international trade. But within that disaster, you could still see inventory adjustments happening. Businesses would cut production, inventories would fall, a brief recovery would begin as they restocked, then another wave of weakness would hit. The inventory cycle didn't cause the Great Depression, but it shaped the pattern of how the Depression unfolded quarter by quarter. This matters for understanding where we are today. The COVID pandemic triggered a massive disruption that affected all the cycles simultaneously. The immediate shock in early 2020 looked like an instantaneous collapse. But the recovery has been shaped by inventory dynamics. The surge in goods demand in late 2020 and 2021, the supply shortages, the inventory rebuilding, the subsequent glut in 2022 and 2023, all of this follows the classic kitchen pattern, just compressed in time and amplified by the unprecedented nature of the shock. Looking ahead, we need to ask where we are in the current inventory cycle. Based on the pattern, if the peak of inventory building was mid to late 2021 and the liquidation phase accelerated through 2022 and into 2023, we should be approaching or at the trough of the cycle. That would suggest that sometime in late 2024 or into 2025, we could see the beginning of the next restocking phase. But that assumes the cycle plays out on its normal schedule, and there are several factors that could alter the timing. First, the magnitude of the inventory swing during the pandemic was so large that it might take longer than usual to work through. Companies overbuilt inventory to a degree rarely seen outside of recessions, and working through that excess takes time. Second, the Federal Reserve's interest rate increases in 2022 and 2023 have changed the cost of holding inventory. When interest rates are near zero, carrying extra inventory is relatively cheap. When rates rise to 4 or 5%, the cost of capital tied up in inventory becomes significant. This creates pressure to keep inventories lean, which could extend the liquidation phase. Third, companies have learned lessons from the pandemic about the vulnerability of just-in-time systems. Many are rethinking their inventory strategies, potentially moving toward holding more buffer stock for critical items. This could change the amplitude and timing of future cycles as businesses build in more resilience at the cost of efficiency. Fourth, geopolitical factors are creating new uncertainties. The trade tensions between the United States and China, the war in Ukraine, the reconfiguration of supply chains to reduce dependency on single countries, all of these introduce new time lags and potential disruptions that could affect how the cycle plays out. What this means for businesses is that understanding the kitchen cycle is more important than ever, not less. Yes, we have better data and analytics than Joseph Kitchen had in 1923. Yes, we have sophisticated supply chain management software. But the fundamental dynamics haven't changed. Businesses still face time lags between decision and action. they still operate with imperfect information about future demand. They still tend to overshoot in both directions, producing too much when times are good and cutting too much when times are bad. For business owners and supply chain managers, the key insight is to recognize which phase of the cycle you're in and adjust accordingly. If you're in the early expansion phase with inventories low and demand rising, that's the time to be adding capacity carefully, not overcommitting but preparing for growth. If you're in the late expansion phase with inventories building and early signs of demand weakness, that's the time to be cautious, to avoid over-ordering, to maintain flexibility. If you're in the contraction phase with excess inventory and weakening demand, the focus should be on preservation, managing cash flow, working through inventory without panic selling if possible, but recognizing that production needs to come down to match reality. And if you're at the trough with lean inventories and the first signs of demand improvement, that's the time to position for the next cycle, to secure supply relationships before everyone else tries to do the same. For traders and investors, the kitchen cycle provides a framework for understanding shorter-term movements in commodity prices, industrial production, and manufacturing stocks. When you see inventory building accelerating and production running ahead of sales, that's a warning sign. When you see inventory liquidation and production cuts, that often marks a bottom in cyclical industries, though the exact timing can be tricky because it's only clear in retrospect. The cycle also helps explain why economic data can be so volatile from quarter to quarter. GDP growth might surge one quarter due to inventory building, then slow the next quarter, even though underlying demand hasn't changed much. Employment in manufacturing might lag the economic cycle because companies hold on to workers longer than optimal during downturns and are slow to hire during recoveries. Understanding that these fluctuations are partly driven by the inventory cycle helps separate signal from noise. For policymakers, the kitchen cycle presents both opportunities and challenges. During severe inventory liquidations, monetary policy can help by lowering interest rates to reduce the cost of holding inventory and encouraging businesses to stop cutting production. Fiscal policy can help by supporting demand, which encourages businesses to work through inventory by selling it, rather than discounting it heavily. But policy also has limits. If businesses are convinced they have too much inventory, no amount of stimulus will make them increase production immediately. They need to work through the excess first. The cycle also creates risks for policy errors. If policymakers mistake an inventory-driven slowdown for something more serious and overreact with too much stimulus, they risk fueling inflation or asset bubbles. If they mistake an inventory-driven surge in growth for a sustainable expansion and tighten policy too much, they risk triggering a sharper downturn than necessary. Reading the cycle correctly is crucial but difficult. What makes this particularly challenging is that the cycle doesn't always last exactly 40 months. Sometimes it's 35, sometimes 45, sometimes longer if it gets disrupted by other shocks. The amplitude varies significantly. Some cycles show modest swings in inventory and production. Others, like what we saw during COVID, show extreme volatility. The cycle is regular enough to be useful for planning, but irregular enough that you can't simply set your calendar and expect to time it perfectly. There's also the question of whether the cycle is changing in character. Some research suggests that inventory cycles became less pronounced from the 1980s through the early 2000s as just-in-time practices spread and information technology improved. The Great Moderation, as that period was called, saw smaller recessions and more stable growth. But the 2008 financial crisis and the COVID pandemic both showed that when major shocks hit, the inventory cycle comes back with a vengeance. It's possible we're entering a period of more volatile inventory cycles rather than less. The shift toward deglobalization and supply chain resilience over efficiency could increase rather than decrease inventory swings. If companies try to maintain larger buffer stocks, that creates more inventory to manage and potentially larger swings when demand shifts unexpectedly. If trade barriers and geopolitical tensions increase uncertainty, businesses might respond with more cautious behavior, which could amplify rather than smooth the cycle. Climate change adds another dimension. As extreme weather events become more frequent, they create supply disruptions that trigger inventory responses. A drought affects agricultural supplies, a hurricane shuts down refineries, wildfires disrupt shipping routes. Each disruption triggers the same response. Businesses try to secure supply, overorder, build inventory, then have to work through excess when the disruption resolves. These climate-driven disruptions could become a recurring source of inventory cycle volatility. Technology is also changing how the cycle manifests. Artificial intelligence and machine learning are being deployed to improve demand forecasting and inventory optimization. In theory, this should help smooth the cycle by giving businesses better information. But it could also create new forms of synchronization. If everyone is using similar AI models trained on similar data, they might all make the same decisions at the same time, amplifying rather than dampening the herd behavior that drives the cycle. The rise of e-commerce has changed inventory dynamics in retail. Online retailers can adjust pricing and product offerings in real time based on inventory levels. This creates more flexibility but also more transparency. When everyone can see that a product is in stock or out of stock, it affects buying behavior in ways that can amplify shortages or surpluses. The ability to buy from multiple countries changes how inventory is distributed geographically. These are all factors that Joseph Kitchin couldn't have imagined, but they don't eliminate the fundamental time lags and information problems that drive the cycle. One interesting aspect that doesn't get enough attention is the psychological dimension of the cycle. Beyond the mechanical aspects of time lags and production decisions, there's a psychological cycle in business confidence. When inventory is lean and demand is strong, managers feel optimistic. They're willing to take risks, invest in capacity, hire aggressively. This optimism itself becomes self-reinforcing. Multiple businesses expanding at the same time creates a boom atmosphere. When inventory starts building and demand softens, pessimism sets in. Managers become cautious. They cut spending, delay investments, avoid hiring. This pessimism also becomes self-reinforcing. When everyone is cutting at the same time, it validates the pessimism and encourages even more cutting. The emotional swings from optimism to pessimism and back amplify the mechanical inventory adjustments. This psychological aspect is why the cycle can overshoot in both directions. Businesses don't just produce to meet expected demand. During boom times, they produce beyond expected demand because they're optimistic and worried about missing opportunities. During downturns, they cut production below expected demand because they're pessimistic and worried about getting stuck with unsold inventory. The cycle is driven not just by forecasting errors, but by systematic biases in how businesses interpret signals and make decisions under uncertainty. What Joseph Kitchin discovered in 1923 was not just a statistical pattern. He discovered something fundamental about how market economies function when you combine production time lags, imperfect information, and human psychology. The 40-month inventory cycle is a reflection of these deeper realities. It's not imposed from outside. It emerges naturally from millions of independent decisions made by businesses trying to balance the competing demands of meeting customer needs and managing costs. And here's what that means for anyone trying to navigate the economy, whether as a business owner, an investor, a worker, or a policymaker. You can't escape the cycle. You can only try to understand where you are within it and adjust accordingly. Fighting the cycle, trying to pretend it doesn't exist, assuming that technology or better practices have eliminated it, those approaches lead to trouble. The companies that got caught with massive excess inventory in 2022 were often the ones that had convinced themselves the old patterns didn't apply anymore. The companies and investors who do well through the cycle are the ones who maintain awareness of the pattern, who watch for the telltale signs of where things stand, who maintain flexibility rather than overcommitting at the extremes. When everyone else is convinced that inventory shortages will last forever and is ordering aggressively, that's the time to be cautious. When everyone else is convinced they'll never sell through their inventory and is slashing orders, that's often the time to be preparing for the next upswing. This doesn't mean the cycle is easy to trade or that you can time it perfectly. As with all economic cycles, the exact turning points are only clear in hindsight. But understanding the framework, recognizing that there is a 40-month rhythm operating in the background of business activity, gives you a structure for interpreting what you're seeing in the data and the headlines. Right now, as we move through 2024 and into 2025, the inventory cycle is at a critical juncture. The excess that built up during the pandemic has largely been worked through in many industries. Production has been running below consumption in sectors like semiconductors and consumer goods. Inventories have normalized or in some cases fallen below normal. The conditions are being set for the next restocking phase whenever demand picks up enough to trigger it. But there are wild cards. The economy is navigating higher interest rates after more than a decade of near-zero rates. Consumers are dealing with the aftermath of high inflation, even as inflation itself moderates. Geopolitical tensions remain elevated. The shift from goods to services consumption that started in late 2021 is still working through. All of these factors affect when and how strongly the next inventory cycle begins. What we can say with confidence is that the cycle will continue. Businesses will continue to face time lags and uncertainty. They will continue to make decisions about production and inventory that turn out to be wrong in both directions. They will continue to amplify these errors through synchronized behavior. The 40-month rhythm that Joseph Kitchin identified a century ago will keep operating because it reflects fundamental features of how production and markets work, not temporary conditions that can be engineered away. For anyone who wants to understand the economy, who wants to make better business decisions, who wants to invest more successfully, learning to see the Kitchin cycle is like gaining a new sense. Suddenly patterns that seemed random start making sense. The ebb and flow of prices, of hiring, of production, of business confidence, all of it fits into a larger rhythm. And while you can't control the cycle, understanding it gives you a better chance of navigating it successfully. Because at the end of the day, the economy is not a machine that operates according to perfect mathematical laws. It's a human system, shaped by our decisions, our psychology, our limitations. We act with imperfect information, we respond with delays, we overshoot in both directions. The Kitchin cycle is not a bug in the system. It's a feature, an inevitable consequence of how we organize production and exchange in a market economy. Joseph Kitchin gave us the framework to see this pattern. His 1923 paper, analyzing data from decades earlier, identified something that would remain relevant for the next century and beyond. The specific industries have changed. The technologies have advanced beyond recognition. Global supply chains have transformed how goods move around the world. But the underlying 40-month rhythm persists because the fundamental dynamics persist. So if you've made it this far, you now understand something that most business owners, most investors, most economic commentators never learn. You understand that beneath the chaos and uncertainty of economic news, beneath the shifting headlines about supply chains and inflation and growth rates, there's a regular pattern operating. Every 40 months or so, businesses go through the same cycle. Build inventory, cut inventory, repeat. And the question isn't whether this will continue. It will. The question is whether you'll recognize it when you see it, whether you'll adjust your strategies accordingly, whether you'll avoid the mistakes of overconfidence at the peak and excessive pessimism at the trough. The cycle creates opportunities for those who understand it and traps for those who don't. If this changed how you see business cycles and inventory management, if you now have a framework for understanding why supply chains behave the way they do, then you're better positioned than most to navigate what's coming. Because the cycle turns, it always does, and being ready for that turn is what separates those who survive from those who thrive. Thanks for watching.